during the downturn. And actually, since 2014, we've basically every single month continued to set new all-time high levels for jobs. And in fact, we're currently about 2.1 million jobs ahead of where we were even at the height of the last expansion back in 2007, right? And so this is why in a lot of cases I've put here, our biggest strength, which is our economy and our labor markets, and the fact that we continue to be a driver of job growth and economic growth nationwide, but we haven't been able to build the housing to keep pace with that. I didn't bring the building permits with me today, but I can assure you that we don't have 2.1 million more homes than we had back in 2007, and therein lies the challenge from a housing affordability standpoint and a housing inventory standpoint, frankly. But be that as it may, it represented strong fundamentals. It's a good problem to have when we're growing so fast that we can't keep pace with the growth, right? And so consumers were feeling good, and this is the University of Michigan's consumer sentiment, but the Conference Board's Consumer Confidence Index shows virtually the same thing, that consumers were coming into 2020 riding fairly high from a confidence standpoint, just as high or higher than we were even back after the dot-com bubble had started to recover. And of course, consumers were out there spending a lot. In fact, in December and January, again, if you look at retail sales, the levels on the left or the growth rates that I'm showing you over on the right, you could see that actually consumers were spending at an even faster pace over the preceding 2 months, again, before we saw any signs of the coronavirus, right? And so when you look at their finances, this is another reason why I think that we can be optimistic about the recovery, is because consumers were also in pretty good financial shape. When you look at their financial obligations or their debt as a percentage of their income, current personal income, you could see that debt levels were very manageable. Part of this is depressed by the fact that a lot of folks haven't been able to get back into the housing market. So home ownership hasn't rebounded as much as the job market has, as an example. But even when you strip away the mortgage piece and just look at straight up consumer debt on auto loans, student loans, et cetera, debt levels are very manageable relative to the income. So again, we didn't have this big fundamental imbalance where households were over leveraged or had bought some really risky mortgage products or something like that. We came into this with strong fundamentals on the labor market side and on the household finance side. Now, I do think that the market was looking for a reason to correct, and whether it was going to be coronavirus or something else, we were already hearing last year that we're in the midst of the longest economic expansion in history. And so I'm showing you GDP growth with the gray shaded areas representing periods of recession, with the point being that there isn't a period looking back to the 1960s at least where we have a longer expansion, where we have a bigger gap between these gray bars than what you see at the far right-hand side of this chart. And so people were in a kind of, I think the markets were in a mode of kind of waiting for the shoe to drop kind of a mentality. I also think that was fueled by the fact that the financial markets were looking a little frothy prior to this crisis. So what I'm showing you here is sort of like a PE ratio, the way that you would do one for a individual stock or an individual company, where you look at the value, the market capitalization of that company. You compare it to how much money they're making, the corporate profits, right? And what you could see was that we weren't at all-time high, low levels like we were back at the height of the dot-com, but it did look like we were far outside that typical band. In other words, the valuations that we're seeing weren't being backed up by this, or weren't being driven by this, excellent growth in corporate profits. These valuations were growing faster than corporate profits, and that does suggest that the market had been getting ahead of itself a little bit, and was therefore looking for a nudge or something to push it into negative territory, just because it was looking for a reason to correct. Unfortunately, we didn't just get a little nudge. It looks like we got a giant shove in the form of the coronavirus. And that's why I think I want to take a minute to talk about why we really need to take this seriously. And I think that's even more important now as it looks like we might be making some headway on the outbreak itself, and I'm definitely only an econ nerd and not a medical expert or anything like that. But from an economic standpoint, all of these projections and the pace of the recovery and the shape of the recovery, when you hear about people talk about if it's going to be a U-shaped recovery, a V, or if it's going to be a W, right? And we have a double dip. All of that is contingent on what happens in terms of the duration and the depth of coronavirus impact. And so although I'm not equipped to forecast that part of it for you, we do have some estimates that I've brought in, and I think that it's important to again really take this serious, because we're seeing the potential for deeper economic impacts pretty severely, right? And so we've seen that in the financial markets, and I know they rallied yesterday, and then we're a little bit wobbly this morning, depending on what index, but we've basically given back about 3 years worth of run up in financial market wealth. And so that obviously has an impact on people's wealth, but it also has an impact on consumer confidence, both of which are absolutely paramount from a real estate industry standpoint, right? And it's also important from a kind of macroeconomic standpoint, because a poorer population, and when we get the numbers for the first and second quarter in terms of net worth on a per capita basis after adjusting for inflation, is likely to be negative, meaning that the average U.S. household is likely to be poorer when the dust settles on this thing and we actually get data for the period that we're currently sitting in right now, which won't happen for 6 to 9 months. But the reason why it matters is because this is one of the few indicators out there that's actually batting 1,000 in terms of predicting a recession. When the U.S. household on average becomes poorer, we do see an economic recession. And so that's point number one, right? Is that those financial markets translate directly through to household wealth. And that's going to be a problem. It's also going to be a problem from a macro standpoint in terms of our current growth, right? So what I'm showing you here is that same GDP chart that I shared with you earlier on in the presentation, but now I'm showing you the components of our GDP growth, right? Where it's divided up by what consumers have generated and what's been generated by everything else in our economy: government spending, international trade, business investment, accumulation of new inventories, you name it. And what you can see is that the vast majority of our growth, in fact, over the last 3 years or so, it's been about 70 or 80% of all of the economic growth that's been generated has been on the backs of consumers, right? And so not only are consumers out there potentially poorer on their balance sheet, but if they lose confidence because of this volatility in financial markets and all of the other factors going on with unemployment and things like that, and they decide to take a step back on spending, or they're forced to because they lose their primary incomes, right? We don't have a lot of kind of other eggs in our economic basket, if you will. We don't have much to fall back on if consumer spending does dry up. And that's why this has the potential with these, businesses not just slowing down, but effectively coming to a halt in many industries, has such potential to not just impact those industries directly, but also to ripple through our entire economy, because again, consumers have been driving the show from an economic growth standpoint. And indeed, we've seen that consumer confidence dropped sharply. This is the Conference Board's number. But if you look at the number from the University of Michigan, you can see that we had our biggest single month decline in consumer confidence that we had since the financial crisis in 2008. And so consumers are taking that step back and being forced to take that step back. And perhaps one of the more troubling signs from a kind of GDP growth forecasting standpoint is when you look at the monthly annualized increase in retail sales, right? Because we already saw in February retail sales start to decline, and that was pre-coronavirus, right? So that was before the shelter in place or the safer at home or whatever you want to call it in your community. It was really only an issue, the coronavirus, in that kind of final week of February at the earliest. And so the fact that we were already seeing that pullback in the final week kind of outweigh the growth that we had seen for the preceding 3.5 weeks up to that point is worrisome, because we know that these numbers are going to be much worse when we get them for March and April. It's just inevitability, because people aren't able to be out there spending. And on top of that, we've got all these other economic impacts. And I brought tons and tons of charts just showing you and kind of demonstrating the step back that consumers are taking. I won't beat these to death, but I just wanted them to be in the deck so that you have them for a reference, because it doesn't matter whether we're talking about, domestic movies, tickets, if we're talking about Broadway shows, right? We see it at the NBA, and Oscar, my fellow economist at CAR, is absolutely gutted, huge basketball fan, and there's no basketball to be had, right? When we look at traffic at restaurants, there's nobody's going to restaurants. In many cases, you're not allowed to go to a restaurant. We've seen grocery delivery really tick up, right? So Whole Foods and the Amazon, component of food is doing okay and actually seeing tremendous growth, but we haven't seen that uptick in restaurant meal delivery yet, right? So restaurants are definitely struggling, and that means that their employees and the owners of these businesses are struggling as well. Not a great time to own hotels and event centers, right? We can see that occupancy has tanked, and pretty much you pick your indicator, flight traffic, what have you. It's all kind of going down precipitously. And of course, this is where the rubber meets the road on all of this nerdy macroeconomic data, is that 6.6 million people have already filed new claims for unemployment insurance, and that was in a single week. You can see that the 2008 financial crisis pales in comparison to the speed with which we've seen unemployment rolls expand. And that was on top of about 3.3 million, which was the previous all-time high set the week immediately preceding last weekend. And I'm expecting that when we get the numbers for this week, that they will have continued to rise when those come out on Thursday. And so, of course, this has implications for virtually every industry out there. When people aren't working, when they're not earning income, then that obviously has implications for what they're able to spend. Are they able to meet their rent payments? Are they out there shopping for homes? And so these are things that are going to hit us as well in the real estate industry. And of course, we saw concerns about this thing really ramp up quickly when we saw this coming down the pike in February. We started doing a weekly survey of our members to get a sense of just how much impact, and again, things have been changing at a pretty breakneck pace, and you can see that in terms of the attitudes of our members. So we've done this for 4 weeks in a row now, starting that first week of March, and it's really interesting just to see how much things have changed even amongst just our members since this thing started that first week of March, because we went basically from roughly half of all realtors believing that there was going to be some kind of a negative impact to their own individual business, to the last couple of weeks that's stabilized around basically 100% of members expect to be negatively impacted by this thing. When we asked if they've seen clients actually holding back generically, like getting cold feet, again, that number has gone up from 54% to almost 100% of all realtors are experiencing some hesitation on the parts of clients in a generic sense. And more specifically, we've seen over the last 2 weeks, we added the question, have you actually had buyers withdraw an offer, not just get cold feet and be wishy-washy, but actually withdraw an offer? And that's gone up to 42%. It's important to point out that 58% of buyers do, continue to move forward or have kept their offers out there. It's not that demand has dropped off to zero. We're in a chronically undersupplied market. That's why I'm optimistic about housing's recovery whenever that may actually occur. But we are seeing a lot of buyers getting cold feet or just losing their ability, right? They might have lost their job and had no choice but to withdraw that offer. And you're seeing kind of similar trends on the sell side, going from 45% of members to 3 out of 4 members who expect negative, who have seen clients hold back from selling, right, on the sell side. And again, when you look at removing or withdrawing listings from the market, that's gone from 13% to up to 44% of members. So almost half have seen sellers not just get cold feet, but actually pull that listing down off the MLS and enter a kind of wait and see mode. So definitely going to have impacts for our business, no doubt about it. In addition to just the broader kind of economic impacts, this is affecting the psychology and the ability of buyers and sellers to be out there in the market. And of course, almost 30% have actually had a transaction fall out of escrow. So Elias nailed it, and I think it's more important than ever to be on your game and to be the expert, because there's a lot of challenges coming down the pike with appraisals and people's mortgage finance qualifications. So you want to make sure that you have all your ducks in a row and are working with good lenders or have all that information, because these transactions that are going through are being challenged, and you're seeing a lot of transactions actually fall out of escrow. So our clients need us more than ever, and we're going to be in for a pretty tough time. So we've also started pulling data out of the MLS on a daily basis, because we really want to be able to keep track of just how this thing is shaping up, and to also keep an eye out for any potential inflection points. But the number one question that we're getting is like, what's going to happen with sales? How much are they going to fall? And what's going to happen with prices? And how much are those going to fall? And so we've started pulling the data out of every single MLS every night, so that we can come in the morning and look at day by day what's happening. Because if you look at our normal market statistics, we publish those on a monthly basis, and we just put out February a few weeks ago, and we'll now be putting out March in about 4 or 5 days. Again, a month is a lifetime ago in terms of the pace of this virus. So I want to share some of this analysis that we've done out of the MLS to just show how this is rippling through to the actual market and our income generating potentials. And so what you can see is that the number of closed sales started declining pretty much after the governor made his kind of shelter in place orders, or when the Bay Area, I think, went on the 14th or the 15th of March. And what you saw was that sales across the state, including in the Bay Area, started to drop off. From in the Bay Area, we're talking about going from 113 average closings a day in that second week of March down to about 92, right? And so that's about a decline of almost 20 transactions, which doesn't seem that bad, but 20 on a base of 113 is still a double-digit decline. And it's important to keep in mind that these are daily closings, right? So if there's 22 or 21 or 23 transaction days, trading days, business days in a month, that 20 a day translates into several hundred lost transactions every single month, right? And so you can see that this is happening in the Bay Area, but it's also happening across the state as well. And in fact, when you look at what happened over the last couple of weeks, we're talking about double-digit declines in terms of the number of closed sales. It does seem like in the Bay Area, at least, that closed sales has kind of stabilized over the course of the last week, especially in the East Bay, right? Around 23, 24 in Contra, Costa, and about 17, 18. We lost our connection to the Sacramento MLS for a couple of days there, but you can see that the trend across the state and within the Bay Area are generally the same. So closed sales are still holding up relatively well. Where you see bigger impacts is on the number of new listings, and there we've essentially seen the numbers cut in half. So if you go back to the beginning of March in the Bay Area, as an example, we were putting up 190, 170 new listings onto the MLS every day, and that has dropped off again from about to about 75 a week and a half ago, and then 91 in the most recent data. So it does look like new listings may be stabilizing. So activity has dropped off, and it's basically been cut in half or a little bit more on the new listing side, but it hasn't dropped off to zero, and it does look like it's stabilizing. So there's going to be half the amount of business, but it's not a full scale decline. And I think that there's still business out there to do. You're going to have to do it remotely as much as you can to continue to combat the virus, but there is still some demand out there. And again, the fundamentals were there, but you do have a lot of, at the same time, impacts from the coronavirus as buyers and sellers do take a step back. And we need to hunker down too, because when you look at this in the Bay Area, again, you can see that they bounced back a little bit, but we're still very low from a new listing standpoint. But what you see on a county by county basis is that nobody's really exempted from this, right? So again, dropped by half in the East Bay, dropped significantly in San Francisco. These are single family listings, which is why San Francisco is so small, but you're talking about virtually no new activity coming on in Marin. San Mateo, we're all down in the single digits in terms of how many new listings are coming down the pike. And so again, we've got to hunker down. There is still demand, and when the dust settles, I think that housing will bounce back, but there's going to be a period where sellers don't want to put their homes on the market. They don't want people walking through, and virtual tours and things like that maybe are an alternative, which is why you haven't seen this go to nothing, right? But to expect this to bounce back quickly, I think is really, again, contingent on what happens from the perspective of the virus. And that's especially true when we think about closed sales, right? So you can see the biggest impacts when we talk about new stabilizing, right? And there might be some listings coming on board. There's issues on the demand side, shall we say, with both the desire, right? And I'm less concerned about the desire because we know that, but the wherewithal, especially in the context that pending sales and closed sales, therefore, are going to be pretty weak, at least. And so we can't expect, even though those closed sales numbers that I was showing you for the Bay Area earlier were fairly stabilized down at this lower level, we can't expect them to come screaming back until the virus gets under control, because, again, people aren't going pending, right? And that's true all across Sacramento County. I could have swapped out these slides for what you see in Southern California, and you're seeing the same exact things in LA and San Diego and Orange County and the Inland Empire and the Central Valley as well. So the story right now is pretty much a macro story. And although I have some of this good local data for you, and we have tons more on our website, the story is largely the same. Regardless of where you look. Now, that's the kind of depressing part, right? Is that the macro economy is in for a tough one, and that the housing market is already feeling the effects. But I do want to hopefully, cheer you up or give you some solace and reason to kind of get out there and hustle for it, virtually get out there, is because I do think that real estate is poised for a strong recovery eventually. And that's why I wanted to bring, again, this context slide, which shows you, 60 years worth of interest rate data to highlight the point or underscore it or put it in bold face or what have you, that we're in a low rate environment, and that is good for housing, right? I still remember being, a kid in the 80s with my dad at his dinner parties when he'd like walk around and they were all like smoking cigarettes in the house, and he was bragging about his 12.5% mortgage interest rate, right? And so I think that when the dust does settle and people get back to work, these low rates are really going to favor housing in terms of the recovery, especially in California, where, we've got a lot more people that need to finance housing, but especially in particular where in the Bay Area, where home prices are so high that little movements even in interest rates have big impacts in terms of the amount of dollars that you need on a monthly basis. And so, we can't expect huge movements while we're still battling the coronavirus and people are still sheltering in place. But when again, we can start to get into a recovery mode, this is a big macro factor that really favors housing, and why I think that housing will come back, especially if we can combine that. And this is something that we're working on our lobbying efforts with some kind of incentive for first-time buyers, et cetera, then that can really help to create a snowball effect where people jump in to the housing market and take advantage of this opportunity to get in when rates are pretty much the lowest they've ever been. From a historical standpoint, I know my dad would be rolling over in his grave right now, wishing he could be alive to refi at 3.5%. Yeah, I think for him that would be really unheard of, and why it's something that we can be encouraged about. And I think we could even see rates go lower than they are right now. There's a lot of friction and technical shenanigans happening in the mortgage market right now, with servicers and liquidity in the MBS market, and what's going to happen with the Fed's quantitative easing and how much of that's backstopping Fannie and Freddie, and can we translate some of that into jumbo loans. There's all kinds of stuff, and we can nerd out on mortgage finance in the Q&A if you want. But the main takeaway is that spreads are really high. 30-year fixed rate mortgages are much higher relative to 10-year treasuries than they typically are. They're usually only about 170 basis points or 1.7 percentage points higher. And now we're looking at spreads of almost 300%. And so I think that suggests as well that when we can get these issues and these frictions worked out in the mortgage market, that we could see rates drop even lower than 3.5%. It's not unthinkable, although I think there'll be still some risk premium pricing on mortgages, but it's not unthinkable that we could dip below 3% for mortgage rates over the course of the next 6 to 9 months, again, predicated on whatever happens with the virus wrapping up and us getting back into a kind of expansion mode again by the third or fourth quarter. The other thing is stocks are a mess, right? And I know that stocks have gone up by 1,600 points, right? It used to be crazy if stock market went up or down by 1,000 points, and that seems like it's been the rule rather than the exception. But I think when we compare the economic uncertainty that's still out there, and the fact that I think that the stock market was much more overvalued than, say, the housing market prior to the crisis, that the real estate market and housing in general might look a lot more attractive on the tail end of this thing vis-a-vis stocks, right? If they think that there's potential for more volatility and a double dip in the economy or something like that, that housing is always the safer long-term growth potential, and why I think that you'll see investors and are already frankly seeing the housing market to maybe come in and get some properties where people are willing to make a price concession to get in while the getting's good, just to shelter their money and their wealth from further declines in the stock market. So those are some of the reasons why I'm still optimistic. And I'll just remind you, although these are numbers from a lifetime ago in February 2020, that we did come in on a strong housing market and we're poised for a pretty nice year, with sales having grown by 6% in February. And actually home prices have started to re-accelerate to about 8.5%, 9%. So we were on a strong footing coming into this thing, and we have a lot of opportunity and potential for growth on the tail end of this thing. But I'll just end it by saying that, it's really hard to put a specific number on this. When you ask me what my forecast is, this is kind of our mode that we're in from a forecasting standpoint. We're in a head scratch mode, right? And we're not alone in that. So what I've brought is a smattering of forecasts that you're seeing from different forecasting shops out there. These are all reputable shops. These are the people whose publications I read to stay on top of stuff. And, I don't necessarily favor any one over the other. And I think the main takeaway from this slide is just to look at the range of potential outcomes that are still being forecasted for Q2. It ranges from, a decline of about 6.5% all the way up to 34% in the second quarter by Goldman Sachs. And actually, I didn't put it on here, but the Atlanta Fed forecasted negative 50% in the second quarter. So the moral of the story is nobody knows, right? And the data still continues to come in. It's backward looking. These forecasts are being revised on a daily basis. And the same thing is true on the recovery front, right? So you have some folks who are forecasting that in the third quarter of the year will still be declining. And that's where UCLA and Wells Fargo and even Barclays thinks that it's going to be a soft Q3 as well and will persist all the way through September. Whereas you have other folks like Morgan Stanley or Goldman Sachs who are projecting a third quarter kind of snap back recovery where we all rush out to get out of the house and have a meal and be able to sit down in an actual restaurant and drink that bottle of wine or what have you. And so again, the key takeaway on this one is that nobody really knows. And I think that, the Fed realizes how big this thing is and have taken unprecedented action, both in terms of cutting their target rate and also the quantitative easing and liquidity that they're providing to not just, the mortgage-backed securities, commercial MBS, right, and even corporate bonds. So they're really taking unprecedented action. We've got the fiscal stimulus, right, and there might be even more, including a lot of benefits that might benefit you as you need to get through this, including the PUA, the Pandemic Unemployment Assistance, and there's a PNP, which are these forgivable small business loans that you can use to cover lost income or wages for your employees to keep them on if you have assistants and whatever payroll type folks, non-licensee costs for that stuff, right? And there's also the checks that are coming down the pike. And I want to point out that this too shall pass, right? As unprecedented and significant as these economic impacts that I've laid out for you here are, when you look at other outbreaks and disasters, the recovery happens over a period of months, not years. And that's something that we can take some solace in once we get the outbreak under control. I think that, that is the duration is, and timing is everything though, right? Because I think that in a best case, this is estimates on California about our current crisis. And you can see that the number of beds and hospital rooms and ICUs are gonna, peak. And this assumes that we do a great job of social distancing for a period of multiple weeks. That's already baked in to these numbers. At best, we're looking at getting past this crisis in early June before we can get back to normal. But that's what kind of undergirds all of that uncertainty that I was showing you in those economic forecasts earlier, is just the question mark about when the virus gets under control and when we can actually get back to normal, right? And so here's a couple of different scenarios where, on the right, you can see that if we do a good job of social distancing for a period of 2 months, we really, and that's what they mean by flattening the curve, we get about 14 million total infections nationwide. But if we social distance for 14 days and then try and get back to normal because we're getting cabin fever or we've been at home for 2 weeks and we start to see the numbers flatten out, the amount of people infected goes up almost tenfold. And we're talking about not tens of millions of people impacted, but hundreds of millions. And that's what impacts the duration stuff that I was showing you up here. Because, again, if we can shelter in place and business is really terrible for a period of 2 months, but then we're able to get back to normal, I think that a lot of those 6.6 million unemployed people can get back to work fairly quickly. But if it persists for 6 to 8 to 9 to 10 months and we just try and get back to normal too quickly, then that's the real dagger for the economy, because then businesses start to change their behavior. Some of them go out of business, even with the small business assistance, and they, others learn to run leaner and those jobs don't come right back. And so that's why everything is predicated on getting this thing under control quickly. If we do that, I think that we can have a recovery that looks a lot more like a Hurricane Katrina type of impact, right? Where we have this really sharp surge in unemployment as the disaster happens basically overnight in the case of a hurricane, right? But then again, the recovery happens over a period of months, not years. But if we try and rush back to a normal lifestyle and we have a second surge, or we're not able to flatten the curve, then businesses really have to start changing things, and the picture for their recovery looks a lot different. So that's why we really, stress to the extent that you can, work remotely, serve your clients virtually, stay at home, because the quicker we can get this thing taken care of, the better off we're going to be economically from a long-term perspective. You don't want to cut off your nose to spite your face in terms of generating some short-run economic benefit at the expense of another 9 months worth of battling through this stuff. So if I had to wrap it all up and put a bow on it, I would just remind you guys that the economy was in good shape prior to the outbreak, but the virus really has changed everything for 2020. What had started out looking like a pretty good year is going to be one of our most challenging years in modern times, right? And so it really is, and hopefully I beat that to death. Unprecedented in terms of its size and its scope on the economic side, and of course, although data is still rolling in, even just a week of data seems like months ago, and so that's why we're trying to stay on top of this stuff daily. When people lose their jobs, though, ultimately, that is the fundamental driver of the housing market. When they're making money and have jobs, they're buying, and when they lose their jobs and aren't making money, that makes it tough. And so we're already seeing those impacts play out across the housing market with sales down, new listings down, although stabilizing at a much reduced level, and pending sales suggesting that the income generating potential for realtors is going to be depressed for at least a period of a couple of months. And so again, just to highlight that the big questions are hinge on whether we get this thing under control and how long we got to shelter in place. And so I think that the moral of the story for me is like the deeper and sharper we can make this contraction, then the shorter we can make it, right? Because it'll have meant that we stayed at home and suffered through pretty terrible business conditions for a month or two, and then we're able to get back to normal. But I think the big risk is that we try and rush out there and really end up prolonging the crisis, and that's really what matters. The duration and the timing, again, is everything. So we have tons of resources out there. There's a lot of, again, fiscal benefits that are available to realtors in particular. We got a lot of different forms and help with electronic closings. We're working on the online notary services so that we can close remotely and all of those things. And of course, we've got our coronavirus microsite, which the link to that is down at the bottom of this slide. And we're updating that, in real time, by the hour, by the day, with new information on economic impacts, legal guidance, what have you. We also have this COVID relief hotline that you can call in and talk one-on-one with somebody who can help you get connected with a lot of these benefits that came out of the CARES Act. And of course, all of our traditional resources that you always have access to for free, just by virtue of being a realtor. And that includes our legal hotline, where you can talk one-on-one with an attorney if you're having issues with a transaction with a buyer or seller. We've got a transaction rescue, where they'll work directly with you and the lender to get past any obstacles there, and the ombudsman hotline as well. So I will say thank you so much to Elias for having me here, and just really commend you guys for wanting to learn, because again, I'll just re-stress that our clients need us more than ever, and that's going to be the key to getting through this, is to be that kind of advisor in chief and the expert for our clients.
Awesome, Jordan. To say that this was amazing content would be a complete understatement. And I apologize if my internet's a little shaky. But here's some key takeaways that I have from this session today is, we're not in, I guess, desperation mode right now. That prior to the coronavirus, our economy was very strong, and this is not similar to what happened in 2008, because that was a completely different situation. This was something that was unforeseen, a pandemic. And I think right now is that we have to, and not to be cliche, but we have to find ways to stay positive, but we have to find ways to be super innovative right now. And we have to start documenting our journey and sharing with our people and finding ways to be creative. And then also for the real estate community, I'm seeing tons of innovation right now, and I'm seeing, sorry about that. I'm seeing tons of innovation. I'm seeing people do different things and communicate in different ways and post on social media in ways that they hadn't before. I think that this is an opportunity that we unify, and B, we get outside of the comfort zone of the way that we've traditionally done our business. And whether that's creating video, whether that's text messaging, whether it's handwritten letters, whatever the case is, I'm going to encourage everybody on this call to be a little bit different, especially in this time. Find ways to be creative and connect with your consumer in an empathetic way. We were on a call the other day, and it stated, we have the ability and the opportunity right now to emerge as a more empathetic industry. And I want everyone to capitalize on that and not be opportunistic, but come from a position of care, from empathy, and really do our best to stay connected with our community, as well as together inside of our real estate community. So what I want to do is I want to address some of the questions here, some great questions here, great information. There was one question here. It came from Janessa, and it says, regards to the drop in February, can't we also say that that was a result of the holiday shopping being over? Is that typical? That was question
Yeah,
number.
so great question. On the retail side in particular, those numbers are all seasonally adjusted. So what we did was we account for the fact that spending typically goes down in January, February relative to December. So that was even after subtracting out those typical seasonal declines and kind of making it apples to apples, that we still saw that number go down. And I think that's a really critical bellwether, just again, because of how much of our economy is relying on those consumers right now.
Awesome, Jordan. Another question we had from Julie. Do we think the unlimited QE we had will have a negative impact on the economy? Specifically, would we have some sort of high inflation after the dust settles?
That's no, I think that the Fed did, judging by their performance last time around, there was tons of unprecedented QE in the 2008-9 timeframe, where they came in and provided a lot of liquidity, directly purchased mortgage-backed securities, et cetera. And I think that the real risk of inflation is that they let it run too hot for too long, right? And that we get down below these kind of natural, what econ nerds like me call the natural levels of unemployment, or the natural rate of economic growth, which we think is around 2.5% to 3%. And so if they used all this QE and left that liquidity in the system long past the recovery phase, and we're really pushing us into an overheated economy, then that could definitely lead to inflationary pressures. Inflation is just the result of too much demand in the economy and not enough ability to meet that supply. And so therefore, producers are able to jack up their prices essentially. And so the only way that happens is if we leave the quantitative easing in too long. They did a great job of clawing that liquidity back gradually over a period of time, that most of the QE, and I think this will be the case this time as well, went into banks in the form of excess reserves, right? This was really about backstopping the financial system, and it wasn't really that this money was then turned around and being lent out like crazy during the worst economic crisis since the Great Depression. It was really about just shoring up that bank's balance sheet, and they were able to claw that back without doing a lot of damage. And I think they did a good job of knowing when to claw it back. And so we'll keep an eye on that for sure. But right now, I'm more worried about the immediate effects, and inflation isn't one of the big concerns I have.
And Jordan, it's more of a comment here. It says, don't you think this has highlighted how vulnerable a huge part of the population is, and what effect do you think it will have? And to some degree, Diane, I agree with you, but that's what this was designed to do. It was to give you some of the harsh realities that we're in right now, but then it was also on an optimistic side. What do we have to look forward to? And if we all do our part with shelter in place and adhere to the social distancing, we'll do our part to get over this quicker. But like Jordan was saying, if we just go out and as soon as shelter in place is released and we're going out there and shaking hands and giving hugs and doing business the way that we would normally do, this is going to have a long lasting effect. And so I hear what you're saying. Was some of this stuff taken out like, oh man, it's a tough scenario for us right now? Yeah, it is, but we know that. But on the flip side, the second part of the presentation was all about how we've rebounded and where we at nationally as an economy. And I think that we're in a good place. What would you have to say about that, Jordan?
Yeah, no, I totally agree. And I think it does underscore that there's a lot of people out there who are only, one missed paycheck or, one major auto catastrophe away from, being homeless. Even, people like, the upper middle class, as I like to kind of, consider myself, is, my wife doesn't work and I've got a mortgage, and even though I'm in a good job at CAR, it wouldn't take long for me to, if that CAR paycheck stopped rolling in, there's not a huge cushion there to fall back on. And that's to say nothing about the people who work in retail or food service, et cetera. And so that's why, up till this crisis, one of CAR's main objectives was really focusing on new construction so that we could get housing affordability back under control and get the home ownership rate going back in the right direction and increasing, because that's the best way that you can protect yourself is to lock in a fixed rate mortgage in today's prices, so that 10 years from now, as a percentage of your income, your housing costs, continues to fall. And so that's the long-term challenge. But I do think that periods of crisis like this just underscore how much of a necessity it is to attack those long-term issues, because they're the easiest ones to kick the can down the road on, and unfortunately the ones that really exacerbate the impacts when stuff like what we're seeing today happens.
Love it, Jordan. And I have a question here from Julie. So can we actually expect interest rates to shoot up in the future after all this, to control inflation?
Possibly, and that is a twofold answer there. So it also is contingent on what happens in the rest of the world, right? One of the reasons why a huge amount of deficit and debt spending on the part of the U.S. government hasn't translated into a big period of inflation is that the U.S. is still a safe haven for money from the rest of the world, right? And so as many issues as we have on spending or debt, twice your annual income. But at the same time, when you look out across the rest of the world, as many problems as we have in the U.S., the rest of the world is more of an economic basket case than us, and that keeps the rate that we have to offer new debt seen as the perceived safe haven. That's why we've been able to, in some ways, get away with murder in terms of running up big deficits and debts without the bond market coming to exact its pound of flesh. And so I guess the poor state of the global economy kind of makes me optimistic, if that's the right word. I'm not sure that it is, but that we won't see a real run up in long-term rates here domestically, at least not for a couple of years.
Jordan, do you think that this is going to mean that home prices are going to drop significantly?
Oh, and I think Elias might have frozen, but let me go into the chat because I see a couple more questions from. So I do think that there's the potential for home prices to go down. What we've started to see in the daily discounting at an elevated rate, right? So we've seen some sellers aren't that substantial as of yet. So we saw, I think I was just looking at a listing this morning, and one listing doesn't tell the tale of the whole trend, but I was just flicking through our daily data, just trying to scan it, and there was a listing that went from, I think, $499 to $485 or something like that. So we're not talking about price slashing, but it does suggest that there'll be some modest reduction, and I think it's still, again, a little bit too early to tell on that front, but that's the price discounts are the ones that I'm really trying to get my head wrapped around. So hit me up online or follow our podcast, because that's the one that I'm going to be really focused on updating in the coming days and weeks.
Jordan, can you hear me better now?
I can. Yep.
Okay, perfect. So for a quick reference, if somebody wants to go back and get all of this information on CAR, where do they go? Can you guide them how to get the presentation that we did today?
Yeah, definitely. So you go to CAR.org. 360 link at the top there, then you'll see all of our stuff. One of the links when you hover that will be presentations, but you'll also then see, and I can see Julie asked, where's the podcast? The podcast is on that same page if you hover over Industry 360. We also have monthly market reports that you can download that actually go down to the city level. So just for time's sake, I didn't go in super granular, nitty gritty, but you can go down there and download monthly reports on what's happening with sales, prices, new listings, discounting every month for all of those cities in your area. And we have like the top 420 or 30 cities in California. So you can pick out Walnut Creek, where my in-laws live, or Concord or whatever. And then there's also a video archive up there, and we have all kinds of good stuff up there. The podcast is there, and you can listen to it on our website, or you can download it through iTunes or wherever else you get your podcast. It's called the Housing Matters Podcast. Or you can just always email me, jordanl@car.org. We're here for you guys, and our main goal is to make sure that you guys are successful in your business, and to be a good partner for you guys, so that you guys make more money and survive this challenge and everything else. So if I can ever be of help, just drop me a line.
I love it, Jordan. And I want us all to stay connected. If you guys want the recording from this today, I can email it to you, or I could send it to you on Messenger or on Instagram. Make sure to add me on Instagram. Make sure to add me on Facebook. BHG is in the midst of putting out tons of great virtual trainings right now to support our agent community as well as the community at large. So we don't close our trainings off to everybody. Some things are special and particular for our company, but we want to make sure that we're opening it up to the rest of the community to join us, to band together, and to unify. So make sure to add me on social media, send me an email if you want a copy of this, and we'll make sure to invite you to different functions that we're doing. But once again, I just want to thank you, Jordan. I want to thank everybody for being on this call today. We really look forward to, growing from this, sharpening our swords, finding ways to stay creative. And so take this time to learn a new skill, to develop new traits that are going to help you not only now, but post, shelter in place. So thank you, everybody, for being here today. I'll be sending out another link for tomorrow's base camp. It's something that we've launched at BHG that's been a huge success as well. So, Jordan, thank you once again for all of your insight and your input and your information. And we'll be connecting soon. But humble thank you to you and to everybody on this call today.
Cheers, Elias. Thanks so much, man.
All right, you guys. Have a wonderful day.